How you doing, folks? I'm Mark Dutram, and welcome to another episode of BayView Views. Today we're going to talk about inflation, because that has been on the topic or on the top of everybody's minds for the past probably certainly this year. Strangely, it's not something we've talked about for the past decade. And if you think about all the government spending that took place in 2008 during the credit crisis, so why was that? Why didn't we see any inflation? If you think about it, back then, most of the money at that time went to Wall Street, and it went to big banks, and it just ended up right back on the Fed's balance sheet. During COVID, they did a much better job of actually getting the money into the hands of Main Street, the people that would actually spend it. And you see this so clearly when you look at the expansion of the money supply and the divergence of what we call the velocity of money, right? And shows up quite clearly in the charts. So inflation, again, that's just higher prices in the future. Some inflation is actually good. We like that. And it really doesn't become a headwind until it starts to curb, consumer spending, and it starts to steal from corporate profitability. And this might be starting to actually take place now. If you look at the consumer sentiment, they've certainly soured over the past few months. But if you look at spending, high frequency data, they've still been really strong. But again, that might be starting to finally take hold with these higher energy costs. And if we look at profitability, it's supposed to grow by about 10% this year. This is after, again, really strong growth in the past few years. But now that those wage costs might start to finally have an impact on profitability. When I think about COVID, what role has it played with inflation? And I think it's either directly or indirectly had a lot to do with the current spike that we're actually seeing in inflation today. Number one, we've seen, again, a lot of targeted government spending, putting money in the hands of the people that will actually spend it, consumers, right? And of course, we've kept interest rates really low. In housing, again, we've seen people wanting to move from the larger cities to more rural areas. And with interest rates really low, it's created this massive demand for housing. With oil back, it was $100 a barrel. Now it's around $80 a barrel today. Energy prices have increased so significantly. And housing and energy are such large components of the inflation factor that, that's why the core numbers look so high. And that's a lot of times why they carve out core. Interestingly, the percentage of an average American's budget that they spend on food and energy today has shrunk significantly over the past few years. So not as big of an impact on our wallet. And then finally, the whipsaw, just the crazy thing that we saw with COVID and the experience of consumer demand really dropping off a cliff. And then, of course, companies trying to meet that drop-off in demand caused massive supply chain disruptions, right? So I think it's had a huge effect. And now we come in with Russia, right? And that's certainly not helped with the stock market, and it's certainly not helped with our fear of it kind of fueling inflation. So the effects of Russia will probably have a larger impact on Europe than it has on the United States for a couple of reasons. The U.S. anymore doesn't really import a lot of energy from Russia. Matter of fact, we've grown quite energy independent, which is very cool. And then we don't import a lot of the grains. Again, that big bread basket of Russia, which they're tremendous exporters of, just really doesn't come too much to us anymore. And then, the topic nowadays is the dreaded yield curve, the inverted yield curve. And again, that's where the long end rates are lower than the short end rates. And such a great predictor of recessions, and typically is. I would say a couple things that are quite noteworthy of today's yield curve is, number one, there's been a tremendous amount of manipulation, in this yield curve. So its dependability as a predictor of recessions, I would say, is a little bit suspect today. And then again, most of this in the yield curve could be explained with the demand. You'd have a higher demand for shorter term interest rates due to a surge in inflation, right? And then with the Fed expected to raise interest rates 9 times coming up, yeah, you would expect shorter end of the curve to be higher. And also in the long end of the curve, this suggests that basically market participants would expect longer rates to be lower because they're expecting, again, growth to slow in the future. That's a rational assumption. We are clearly in the mid to late stage of this business cycle, which would be accompanied by slower growth going forward. So what is the forecast for future inflation? If you look at the fixed income markets, which I think do a much better job of predicting where inflation is going to be and where interest rates are going to go, much better than the government would do, they would expect, to elevation of inflation to remain high throughout, 2022. And then most of the inflation expectations, though, if you look at them, would predict that, a lot of these supply chain disruptions and demand, due to COVID and things like that, these pent-up demand things will start to normalize, right? And the fiscal and the monetary policies that are contractionary will start to take hold. So I don't believe that we're actually headed back into a 70s style inflation. I think the sticky inflation, those things like housing and furnishings and travel, entertainment, medical, those kind of things will probably remain high all the way into 2023. But the more transitory inflation, things like food and energy and vehicle sales, things like that, should start to moderate probably in the second half of 2022. As some of these supply chain disruptions start to fix themselves, et cetera. So when you're checking inflation for yourself, for you personally, you need to look at not only what you're spending money on, but what are the things that are affecting you most, right? And then also look at your assets to ensure that you're kind of keeping up with inflation with regards to your purchasing power. So things that are sitting in cash today become really prevalent that they're not keeping up with it. Matter of fact, we're telling people great time to revisit I-bonds today because again, you're getting tremendous rates of return on government guaranteed types of bonds. So great thing for short-term funds. Guys, we hope this was helpful. Thank you so much for watching another episode of BayView Views. We appreciate you. We try to put these out for educational purposes. If you ever have any questions or anything like that, please reach out. We'll be glad to help. Have a great day, guys.